Hello everyone, Alex Kim here. Silver declined 37% on Friday, January 30th, moving from $121 in the morning session to $75 by the close. Gold fell from $5,600 to $4,700, representing a $900 decline. What makes this move structurally significant isn't the magnitude alone, but the absence of corresponding catalysts in the news flow. No geopolitical escalation, no financial institution failure, no macroeconomic data release that would typically justify a move of this scale. This was the largest single-day decline in precious metals in years, and understanding the mechanics behind it requires looking at exchange-level actions rather than narrative-driven explanations. The pattern isn't new. It's happened twice before in the past 50 years under remarkably similar circumstances, and examining those precedents reveals how futures market infrastructure can be used to manage price when leverage becomes concentrated. Silver entered Friday having posted a 65% gain in January alone, the strongest monthly performance in decades. Sentiment was extremely bullish. Price targets of $200 to $300 were circulating widely. The psychological assumption was that $100 would act as durable support. At 9:30 a.m. Eastern, when New York markets opened, institutional-scale sell orders hit the market simultaneously. These weren't retail profit-taking transactions. The block sizes indicated coordinated selling of millions of ounces executed within minutes. Silver dropped through $115, then $110, breaking below $100 and continuing through $95, $90, $85 and $80 before settling at $75. Stop-loss orders triggered across the curve, margin calls flooded brokerage systems, and positions were liquidated automatically regardless of account holder intent. The mechanism forcing this liquidation wasn't organic selling pressure, but exchange-imposed margin requirement increases. Between December 12th and January 28th, the CME Group raised margin requirements 4 times over 6 weeks, culminating in an 80% total increase. December 12th saw a 10% hike. December 29th brought a 25% increase. December 30th, less than 24 hours later, another hike was implemented. January 28th, 3 days before the crash, the CME shifted from fixed dollar margin amounts to percentage-based requirements, raising the effective margin from 9% to 11%, and for higher risk accounts to 12.1%. This isn't speculation. This is positioning. Margin is the collateral required to hold a leveraged futures position. When margin requirements increase, every account holding positions must deposit additional cash immediately, typically within hours. Accounts unable to meet the new requirement are liquidated by the exchange automatically. An 80% increase in margin means traders suddenly needed 80% more cash in their accounts to maintain existing positions. Most leveraged accounts don't have that liquidity readily available, which forced widespread selling concentrated within a narrow time window. When thousands of positions are liquidated simultaneously, price doesn't adjust gradually, it collapses. The January 30th decline wasn't market participants organically reassessing value. It was forced liquidation driven by exchange rule changes. This exact mechanism has been deployed twice before during major silver rallies. In 1980, silver ran from $6 to $50, an 800% gain over several months. The CME responded by implementing Silver Rule 7, which banned leveraged buying and required 100% cash for new positions. Simultaneously, the Federal Reserve raised the federal funds rate from 11% to 20%. Silver subsequently crashed from $50 to $10, an 80% decline. In 2011, silver rallied from $8 to $50, a 600% gain. The CME raised margin requirements 5 times in 9 days, totaling an 84% increase. Silver crashed from $50 to $26 within weeks, a 50% decline, and didn't recover to those levels for 13 years. Now in 2026, silver moved from $26 to $121, a 450% gain. The CME raised margins 4 times in 6 weeks. Silver crashed 37% in a single day. 3 episodes across 50 years, following the same structure: rapid price appreciation, Multiple margin hikes compressed into a short period, forced liquidation, and sharp price declines. The pattern isn't coincidental. It's a demonstrated exchange-level tool for managing leverage concentration when futures positioning becomes extreme. The question worth examining is why exchange authorities consistently intervene during precious metals rallies, rather than allowing price discovery to proceed unimpeded. The answer relates to broader monetary architecture and the role metals play in signaling confidence in fiat currency systems. The US dollar functions as the world's reserve currency, which allows the United States to issue debt and print currency at scales other nations cannot sustain because global trade and central bank reserves require dollar liquidity. That privilege depends on maintaining confidence in dollar stability. When gold and silver appreciate rapidly, particularly in the absence of proportional moves in other commodities, it signals declining confidence in paper currency systems. Central banks purchased over 800 tons of gold last year, marking a structural shift in reserve composition. In January alone, central banks sold $48 billion worth of U.S. treasuries. The dollar's share of global reserves has declined to 58%, the lowest level since 1995. For the first time in modern history, gold now represents a larger share of central bank reserves than U.S. Treasury bonds. That shift reflects a fundamental reassessment of counterparty risk in sovereign debt versus physical assets. The nations leading this reallocation are primarily BRICS members: China, Russia, India, Brazil, and South Africa. These countries are building payment systems that bypass dollar-denominated settlement and are accumulating physical gold at accelerating rates. China controls 60% to 70% of global silver refining capacity, 90% of rare earth element processing, 98% of gallium refining, 80% of cobalt processing, and 60% of lithium refining. On January 1st, China classified silver as a strategic national security resource and implemented export controls. Watch the flow, not the headlines. China's strategy centers on controlling physical supply chains for critical materials. The U.S. strategy requires metals to remain suppressed because elevated gold and silver prices undermine confidence in fiat currency stability. If silver reaches $500 or gold reaches $10,000, the implicit message is that 50 years of monetary expansion has eroded purchasing power to a degree that markets can no longer ignore. That message cannot be allowed to propagate unchallenged, which is why exchange-level intervention recurs whenever metals threaten to break out structurally. The dollar index had been declining for months, falling from 110 to 95.55, a 4-year low. When the dollar weakens, metals typically appreciate because they're priced in dollars globally, and because dollar weakness signals reduced confidence in paper currency. At 95.55, the dollar found support and began reversing higher. Silver's crash occurred at that exact inflection point. The margin hikes created the mechanical liquidation pressure. The dollar reversal provided the narrative cover. The timing wasn't coincidental. It was coordinated across multiple policy levers simultaneously. Are you seeing the same disconnect between paper pricing and physical availability in other commodity markets, or is this divergence unique to precious metals? If you find this breakdown useful, consider subscribing so you can track how these structural distortions evolve. Before Friday's crash, when silver was trading at $121, physical markets were already dislocated. The Perth Mint in Australia had suspended wholesale orders due to backlog. The U.S. Mint halted Silver Eagle sales. Dealers were defaulting on deliveries because they couldn't source supply. Despite a spot price of $121, physical silver was difficult to purchase at any premium. Now the spot price is $75. Try buying physical silver today. Check dealer premiums over spot. Check inventory availability. The paper price says $75, but the physical market reflects entirely different supply-demand dynamics. Paper silver and physical silver are fundamentally different instruments. Paper contracts can be created through leverage. Paper positions can be liquidated through margin calls. Paper markets are controlled by exchange rules that can be modified overnight. Physical silver cannot be printed, cannot be margin called, and exists independent of exchange infrastructure. When you hold physical metal, No exchange can force liquidation. No margin hike can confiscate it. The divergence between paper and physical markets is widening. While American accounts were being liquidated on Friday and paper prices were collapsing, Shanghai vaults drained 27 tons of silver in a single day last week. That metal wasn't sold on exchanges. It was removed for physical delivery to buyers taking possession. This has been the pattern for months. Western participants trade paper contracts. Chinese buyers take physical delivery. Western exchanges crash paper prices. Chinese buyers interpret that as a discount and accelerate accumulation. One side trades promises on screens. The other side loads trucks with metal. Which side understands silver's value more accurately is worth considering. The fundamentals supporting silver didn't change on Friday. Silver has been in supply deficit for 5 consecutive years. Total cumulative deficit exceeds 800 million ounces, nearly a full year of global mine production. Industrial demand continues growing. Solar installations, electric vehicles, electronics, AI infrastructure, and defense applications all require silver in quantities that exceed mine production. No major new discoveries have been made in years. Ore grades are declining at existing mines. It takes a decade to bring a new mine online even after discovery. Production costs are rising. Demand is increasing, supply is constrained, and the deficit is structural. None of that changed because paper prices fell 37%. What changed was a number on a screen controlled by futures contracts and margin requirements. Paper prices can be manipulated through exchange rules. Physical supply and demand cannot. After the 1980 crash, silver eventually recovered. After 2011, silver eventually recovered. Both times it went on to make new highs. Suppression can be maintained for extended periods using the tools available to exchange authorities, but it cannot override physical reality indefinitely. Supply and demand fundamentals eventually reassert themselves. The question is timing, which nobody can predict with certainty. What is knowable is that the CME raised margins 4 times in 6 weeks, and silver crashed 37% in the final week of that sequence. This pattern has occurred twice before over 50 years. Both times, silver eventually recovered. China controls most global silver refining and just implemented export controls. The US crashed the paper price. Central banks are selling treasuries and buying gold at the fastest pace in decades. The physical market was dislocated before Friday and is now more dislocated. The gap between paper prices and physical availability is wider than historical norms. What isn't knowable is whether $75 represents the bottom. Silver could decline to $50. It could rebound to $100 next month. Anyone claiming certainty is either mistaken or selling something. This is not a retail story. If silver genuinely didn't matter, exchange authorities wouldn't need to intervene 3 times across 50 years using the exact same playbook. If precious metals were irrelevant relics, China wouldn't be stockpiling physical supply while implementing export controls. The intensity of intervention reveals the perceived threat. You don't fight this hard against something that doesn't matter. The fact that they keep deploying this mechanism, that 3 times in 5 decades they've crushed silver whenever it started breaking out structurally, reveals exactly what silver threatens and what authorities fear. In 1980, the narrative was stopping manipulation. In 2011, it was ensuring market stability. In 2026, it will be framed as healthy correction. But the pattern is consistent. Margin hikes, forced liquidation, price destruction. Meanwhile, China accumulates physical metal. Central banks choose gold over treasury bonds. The gap between official narrative and observable behavior widens. The public narrative lags the positioning. The paper price says $75. But paper is a claim, a promise that can be margin called, defaulted, or frozen. Physical metal exists in the real world, cannot be printed, cannot be hacked, cannot be confiscated through exchange rules. They can crash paper prices. They cannot crash the metal itself. They can liquidate futures contracts. They cannot liquidate physical silver in private storage. They can manipulate markets for extended periods, but they cannot manipulate physical reality indefinitely. One system depends on unlimited printing. The other cannot be printed. Eventually, one of those frameworks prevails. History has already voted on which one. Many voices will advise selling now, cutting losses, exiting while possible. That may be correct in the short term. Silver could decline further from current levels. But if silver were truly worthless, if gold were genuinely irrelevant, why raise margins 4 times in 6 weeks? Why deploy the same playbook across 50 years? Why would China stockpile physical supply while the US crashes paper prices? The intensity of the intervention signals the value of the target. Friday wasn't a crash driven by fundamentals. It was forced liquidation driven by exchange rule changes. It was also confirmation that after 50 years of fiat currency and unlimited monetary expansion, authorities still haven't figured out how to make gold and silver irrelevant. That might be the most structurally significant signal of all. The margin hikes are documented. The dates are public. The pattern across 1980, 2011, and 2026 is there for anyone willing to examine it. China's accumulation while America liquidates. Paper versus metal. A conflict between monetary systems that nobody discusses openly. The data is available. What you do with that information is your decision. How do you think the divergence between paper pricing and physical availability resolves? And what does that timeline mean for participants on either side of that trade? Share your thoughts below, and I'll continue tracking how these structural tensions develop from here.